So, welcome everybody. Thank you for joining us this evening. It's a pleasure to have everybody here virtually, of course, and join us for a very intriguing session and an interesting one with a set of seniors. All of them are very well known to me personally, and I'm sure all of you would feel like that also at the end of this session. So we have with us Vivek Bajaj from the 2005 batch, Devam Modi from the 2007 batch, and Vikas Agrawal from the 2007 batch also to take us through their own respective journeys of over 12 years that they have had since their graduation from IIM Indore. And each of them is today a successful entrepreneur in the financial market space. And each of them will share with you some insights on how it was in the past decade or more. And if you are interested in doing the same and following in their footpath, in their footsteps, what to watch out for and what to do right. So the session is going to be split into two parts mainly. The first part is going to be each speaker doing about 10 minutes of an individual introduction on themselves and their businesses and their journeys, which will be followed by a moderated session on the Q&A that are asked, that are raised during the hour. Everybody, please feel free to raise questions on the Q&A panel, which is on the app or on the screen. And we'll try and take as many questions as possible during this session. So I'm going to hand over to Vivek now, who's the first of our panelists. So over to Vivek.
Hey, Pranav, thank you so much. I hope I'm audible to everyone. Okay, just quick round of check from everyone. You can confirm in the question panel whether you can hear me. A quick round of yes from everyone would help me. Yeah, thanks. Yeah, pretty much. I can see most of you can hear me. So thank you so much, Pranav and the entire team for organizing this. I think it's one of the best things we could have done at this stage, at this juncture. So I have 10 minutes to talk about me, and I thought that what better than talking about the challenges which I have faced as an entrepreneur and how my journey as an entrepreneur has evolved immediately after the graduation from our alma mater. So I hope you are able to see my presentation. So I'm as usual, I'm so used to drawing PPT boards, so I will have to have PPT supporting me. That's what they have taught us, right? So anyways, so I'm going to use my PPT for the purpose of this presentation. So here we go. So this is the quote which is very close to my heart, and I always strongly believe this, that the first stage of entrepreneurship is to think about taking risk. And I believe this quote which Swami Vivekananda said is, you take risk in your life. If you win, you can lead. And if you lose, still, you are a good mentor, you are a good guide for other people. And that's what, fortunately, I have done very well. I would not say that I'm grossly very successful. Still, there's a long way to go, because in terms of adding value to society, the quest is still on. But still, in terms of developing right products for right people, I think pretty much I'm in good track. So I'm going to talk about the risk which I took at every stage of my career. Why I took that risk, because this is a typical question with all of us will have in mind, that why someone would take the risk, what is the fallback option, and ultimately what return one generated after taking that risk. My presentation will not be very technical investing oriented. I have two phenomenal panelists who are, I'm sure, going to put a lot of insight into investing world. But after 30 minutes, we will have a lot of Q&A related to investing. So kindly look at me from my journey perspective right now. So the first level of risk which I took after I did my chartered accountancy in 2001 was to join a mutual fund company in Mumbai in sales department. And that was actually quite a risky proposition, because no one would really want to do a sales activity after one has done a CA. But the strategy was that I wanted to get out of the comfort zone of doing orthodox in-office job. As a chartered accountant or any research-oriented job, you always want to prefer to be in office and do more sedentary work, because that always gives us physical comfort. But then I wanted to get out of that comfort zone and get into a hardcore sales activity. The fallback was that I was a CA, so I could have always assumed that I will get at least an accountant job in my career. But the gain which I got was I learned the art of selling, which is, I think, the most important life skill with which anyone can inculcate. And that can only happen once you actually go inside the job. No one can actually teach you sales bookish. No business school can teach you sales, but obviously we can, and we have been fortunate to attend that sessions. We can lay the foundation of how to do sales, but obviously we can't excel in sales till we do it. In 2002, the other risk which I took is I came back to Calcutta. That's where my family base is. That's where I've done my study. And I started my own mutual fund distribution business. Now, the strategy there was that mutual fund industry that time was poised for a growth. Unit 64 crisis happened round about that time, and it was a good opportunity for me to build up a business there. But the fallback was always that my family is based out of Calcutta, so I always had this feeling that कुछ नहीं हुआ तो कलकत्ता में एटलीस्ट कंफर्टेबली रह पाएंगे परिवार के साथ. But the gain was that I understood the art of conceptualizing a business and I witnessed failure. And I think this was one of the most important learning in my life that I failed in that business miserably and I was quite directionless what to do. But then fortunately during that time derivatives market was launched in India and because I had a bit of background of financial market because of my family, I got into derivatives trading with my family and fortunately we were able to make good money for ourselves because that time there was a very good arbitrage opportunities available in derivative markets, kind of free lunch for people who were there in the market during that time. Now in 2003, again, I took a risk and I went for my MBA during the peak time of my trading career. I was actually making good money as a trader, but I thought that the strategy was that I can make certain money as a trader, but I can't build a business around it. So I thought that I should develop my broader business skills and learn the art of doing business from some good business school. The fallback was I already was doing trading, so it was not a question of survival anymore. And the gain was how to after doing my MBA, you know that the kind of gain you get is how to manage people, how to think big, and how to build team around your bigger vision. The risk four which I took after my MBA was I did not join JP Morgan. That's where I got the placement. Thank God I was part of the placement committee, so I got one of the best jobs there. Just kidding. So I got placed in JP Morgan, but I didn't take the job. I took a job which was half the salary in a broking firm where commodities market was just growing in our country. So the strategy was explore new industry and become early mover there because A, there are not many smarter guys already there, so you will get highlighted very fast. And second, you learn a lot when you are part of a new industry. The fallback was MBA तो है ही तो नौकरी तो लगी जाएगी. And the gain which was phenomenal is that I started thinking big and I started realizing the potential of building team around that big vision. Now, the risk five which I took was in 2006. I left everything. I came back to Calcutta and I started my own commodities trading desk. The strategy was commodities market was something which I knew, I understood, and I thought I can build a business around it. So I started my own trading of commodities and then I expanded and built up my team. Fallback was कि family business is there. कुछ तो कर ही लेंगे कलकत्ता में वापस जाके. And the gain was I built an organization which has almost 200 full-time employees, full-time traders and support team and knowledge and research team working in our desk right now. 2006, I realized time to take another risk, and I thought algo trading is going to be the big thing globally, and it is already a big thing now in India as well. So I collaborated with some, and I am not a techie, I am a chartered accountant, so I don't understand tech at all. At least during that time, I can say. And I collaborated with a team of IIM graduates, and we started algo trading based out of Bombay. It's called iRage. The strategy was algo trading is going to be a big thing, and manual trading is going to get marginalized and suffer. The fallback was I was already making money as a manual trading desk owner. The gain was I learned the art of trading technology. Now anyone can actually compete with me on technology. I am pretty much updated on the quant and the technology part of the market. Again, 2013, the next level of risk which I took when one of the IIM Indore 2 years junior, Vineet Patawari from Calcutta, he joined us and we thought that now let's do something bigger for society. बहुत हुआ, कुछ अलग करते हैं, कुछ बड़ा करते हैं. And the strategy is to do what Michael Bloomberg has done for institutional investor. Can we do it for retail investors? And we have been continuously building on the whole ecosystem, which is relevant for individual investor to become independent in market. The fallback is that fortunately for 10 years of hard work, we have already built a capital for ourselves. So घर खर्चा चल जा रहा है, कोई problem नहीं है. So there is an opportunity to look beyond the ghar kharcha. The gain is now I am much more satisfied of what I am doing, because now I am doing something for the larger goal, and it will eventually add value in society. So as we speak, these are the two products which we are very much focused. eLearn Markets is the largest portal, e-learning portal of financial markets in India. We have almost 200,000 learners now with more than 100 modules and 100 experts. We create a lot of YouTube free videos. If you visit YouTube, eLearn Markets, you'll see a lot of fantastic videos created by us. And StockEdge is turning out to be a Bloomberg for retail investor in India, with everything which an investor would need to analyze stock market as well as mutual funds, right? This is where you can connect with me. I'm pretty much active on Twitter. My handle is Vivek Bajaj. I'll be more than happy to guide you, to help you, to answer your queries and see if I can add any value to your career. I'm pretty much done. Now may I request our other speaker for him, Devan. Yeah, let me just open a panel.
Yeah, thanks, thanks Vivek, and it was really inspiring to hear. And thanks for this opportunity, all of you guys. Would really like to thank the entire team that has been involved in doing this, for setting this up. So let me do this. I think I'll again go for around 10 minutes, share my journey, and share a little bit of what we do at Ardeko towards the end of it, after sharing a little bit about. So what I'll be, I'll have a talk around around the journey, and then I'll come to the Ardeko piece and have a small few slides to show over there. And also I would like to thank all the people who have taken out the time to listen into us, all the alumni, and I'm sure there will be many existing as well as prospective clients who are around here and have taken the time to listen into us. So yeah, very quickly I'll get to sharing the journey on setting up Ardeko. So this is all with the caveat that, Vivek has been on his entrepreneurial journey since the last almost 15 years now, 14 plus years. In our case, we are around 2 years old, and to be fair, there'll be more time and clients later that I would really call it a raging success per se. For now, it's basically a decision to work on an advisory model in a volatile investing environment. And while it is extremely challenging, but it is a huge opportunity also in our view. So yeah, so getting to the journey, I grew up in a business family and got involved in my father's business at a very early age in the field of restaurants. By sheer chance, or rather more due to my sister, I ended up getting on the IIM bandwagon and was lucky to get through to the Indore, and then extremely fortunate that I met so many different people over there. Literally saw various approaches from close up, and that experience would always be integral to my thinking process and personality. Then after all that, I basically started my career as a project financier with L&T Infra's NBFC in 2007. Now that whole finance unit basically has been spun off into L&T, is a part of L&T Finance Holdings. I got a great exposure there with the NBFC. It was a no holds barred growth mode period, and then going on, basically I was based in Bombay, and I got this opportunity to move back to Ahmedabad in an institutional equity research setup. It was being started under the boutique investment bank Equirus. I was like literally the first employee there, and it was a highly entrepreneurial situation. So there was always a business bug within me, and one thing led to another, and I worked there amidst the entrepreneurial culture for 8 years. Ended up leading the business for a while and really enjoyed the stint, while also developing a tremendous passion for equities and investing. However, given the business background, there was always a business school, and abhi itna pad liya tha, so the opportunity cost of living was obviously high, and it was difficult to come up with a non-finance product or something out of the blue. Ultimately, I wanted to be doing something which I was very passionate about, and then one fine day I got this opportunity wherein I could start out with a base of anchor clients and we had some bit of cash flows coming in from other investments that had fructified by then. So then, and also at that point of time, it is very important to mention that the entire family, whether my parents, my wife, my in-laws, my sister, all of them, my brother-in-law, all of them were extremely supportive, and I decided to take this plan. So that was the journey from which I ended up starting Ardeko in 2018. So I'll just briefly talk about what Ardeko is. Ardeko is a wealth and investment advisory firm. As a team, we endeavor to provide unbiased advice to family offices, businesses, HNIs, professionals on their investment options. The aim is that we don't want to do any distribution, zero distribution, and focus on trying to find the right option for the client. Asset allocation is a key focus area, and we work on debt, equity, and related options for the clients.
Sorry to interrupt.
A bit about the current environment that we are facing. I mean, what has happened in the last few weeks, I'm sure all of you, there's a huge turmoil going on. And so there's this quote which is going around, and most of you would have heard it, that sometimes nothing happens for decades. And then in a few weeks, things related to more than a few decades happen together. So that is something what we are seeing, the kind of market volatility and the kind of developments we are seeing in the global markets. And I'm sure Indian markets are also completely correlated with it. So to begin with, what I just wanted to mention was a little bit, I wanted to dive upon what are the challenges that are facing equity investors, or what is the general situation on the equity side right now, and debt side per se. So this is something that is the base of trying to understand the construct in equity and debt markets. So when we say that, what we are saying is that that on the equity side, you have obviously the FII and DII flows and the market sentiment, which drives the multiple. And then you have the earnings, that is the profit that a business makes, which is a function of the momentum that the business or the sector is seeing, the environment, the capital structure, and all those things. And all these things ultimately leads to the valuations, and the whole a change in either of them can lead to downside or upside in the equity valuations. On the debt side, it is a slightly different construct. Obviously, debt is indirectly linked to interest rates. I mean, when interest rates go up, debt value will come down, and when interest rates will fall, debt value will go up. So I'm sure we all understand that. So the two pillars over here are going to be inflation and fiscal deficit, or money supply in a way. So in this case, obviously, there are too many complex factors that influence each of these pillars. And so this is basically the construct. And so anything which happens to inflation, if inflation rises, it basically means that it is leading to a situation wherein interest rates may have to be reduced. And that basically is positive. Interest rates may have to be raised, sorry, and that basically is negative. Where if inflation is on the downturn, which is the situation right now, then you will generally see government trying to support, because at that point of time, you will typically low inflation will be accompanied with a low growth scenario. So that is there are obviously exceptions to this on the debt side, and probably in a more technical format, we can touch upon those details as well. So key things we keep in mind for debt right now in the current stage is that we are in the late stages of the interest rate easing cycle. For the near term, obviously, there is no way out, but the RBI will have to support the economy and the broader markets by easing. But going ahead over the medium to long term, we believe that there will be mean reversion at some point. But however, the peaks and troughs will be relatively lower than earlier, and India's share of global GDP will rise. What I mean to say is that, let's say, peak interest rates in 1980s were a particular level, 1990s were probably slightly lower than that. Similarly, so we have come down from like 18 to 20% interest rates to a cycle wherein now we are down to 6 to 8% interest rates. So that will keep trending on the lower side. And these three things is what one has to keep in mind from the near to medium term perspective. That is fiscal deficit, growth, and inflation. In the near term, obviously, we expect growth to be weak and inflation to be low. Only point is to see how much fiscal deficit gets a hit, and generally it should be a good time for long-dated debt in this situation. However, it will have to be seen how long that situation continues. And we generally are parking debt on, we are making a mix of a portfolio. But it's a slightly tricky situation because debt requires you to think from a 3-year perspective given the taxation implications. So that is what I just wanted to introduce on the debt front. On the equity front, now this is a very highly debatable and highly discussed topic. So what we are seeing right now is that people are drawing comparisons of the current fall to the global financial crisis and all the issues which happened. I mean, that the fall was a particular 60%, and then there are various corrections in the past that fall has been of this much level. So I think one thing which always keeps moving around is the cyclically adjusted PE, or the profit potential of the economy. So probably what I'm trying to say is that economy and earnings cycle, when this fall began, was already down and out. While probably the economy was at its roaring peak in 2007. So a PE of 15 in 2008 would be like similar to a PE of 18 in 2020. And you have a much more beaten down broader market. We are generally, people end up following the PEs of the indexes. On the interest rates and commodities side, India has had a huge windfall with the input cost being down, and operating leverage could really rise when things settle down. And also, we cannot forget that all of us have, I mean, the whole SIP culture, the rise of the DI has been tremendous. And in India, generally, equity is still extremely underpenetrated. So there can be substantial support which can come from there. On the NPA side, yes, so there is a situation wherein so those are the pros that I mentioned. However, in the current situation, there is a lot of confusion with regards to NPAs, which could spurt up. I mean, the amount of time the lockdown continues, you could have a beaten down economy, and it could lead to high NPA pressures. There are demand woes wherein global trade could remain impacted for long, and hits to any consumption in US or the West also could hurt India export-oriented demand, and there could be various other implications. On the global sell-off front, also there is a huge risk. There are various other risks which are developing over there, whether it is geopolitical, or there could be risks related to global currencies being displaced, debasing happening, and all those sort of things. In that situation, basically what we are trying to say is that while a direct comparison to 2007 may not be possible, there are still several factors which could keep the market volatile in the near term. However, this is the slide which I just want to highlight before I pass on to Vikas. So this is something which is just talking the fact that as long as you are in the right sort of valuation zone when you are investing, and so whenever you are investing in the below 15 or the 15 to 20 P range, you typically end up making a certain amount of return, which is much higher than what one would expect to make on a general basis when you invest in the higher PE zones. So, and we are seeing that at the current point of time, we are in that PE range. So I would feel that given the fact that mean reversion is a huge factor for one to keep in mind in the markets, that these are attractive times. Having said that, there is volatility in the near term, and the market has seen a reasonable rally into the current weekend. So yeah, I think I'll just leave it at that for now. And a great opportunity in the equity side. Debt side is a little tricky from a medium-term perspective because inflation could really move rapidly. And we believe that in such an environment, investors can really make good returns if with the right sort of advice and patience. Yeah, I think that's it from my side for now. Look forward to your questions. Vikas, you can take it from now.
Thank you, Devam. Good evening, everyone. I hope everyone is having a very good time. And I'll be just sharing my journey today it will basically a journey of a trader, basically. It will not just be I am just a part of the journey. But through me, you can see a trader's life, how it goes around and how it progresses. First, I'd like to talk about the audience profile. I believe most of us will be investors. And some would be thinking about trading, some want to learn more. Few might be trading already, and few might be looking for an extra source of monthly income, maybe by selling options or doing something else. And very few, I guess, would be full-time traders who will be having trading systems, full book run. And I believe there are some other candidates too who are there who are none of the above. Talking about my journey, I come from an entrepreneurial family background. My father is a businessman. I have done my commerce graduation from HR College in Mumbai, and I am from the batch of 2007. I've been trading in stock markets in the last 18 years. And talking about entrepreneurship, I've also co-founded a fintech company called FinIdeas around 12 years back. and I'm a full-time option trader since last 12 years. I'll be talking about 3 levels of trading that has taken place for most of the traders in the world, and I'll be taking mine life as an example for what happens in the life of a trader. There are 3 stages to it. Basically, the first one is the beginner trader. There was a phase where I was a part of it. Then comes the next competent trader, and after a certain level, gaining some expertise into it, he might become an expert trader. So I'll be talking about the beginner trader first. These are the early years. At the time when I was completing my school, you'll be interested to know that my father was also a stock trader himself. These were the times of around 92 when Harshad Mehta things were happening, and then post that the 2000 boom was also happening. And I saw my father trading a lot. Well, that time the demat accounts were not there. He used to buy shares, sell shares on the phone. So I got attracted by markets, started following it. Then this was just a learning phase for me. The next phase was the competent trader phase, where my personal journey of trading started. I began trading in around 2003. I made some money multiple times, and then again lost it. I borrowed money, then again made money, then again lost it. So this happens typically for a trader who is very new to the market. There's a very high chance that he might lose all the money. So being a novice trader myself, I made some money and lost it all. This typically is the behavior of the retail trader. Post 2005, a change happened in me. I joined IIM Indore. At that time, I got further more interested in trading. There were a lot of batchmates around me who were also interested in trading. So I got few tools. Just for example, technical analysis is a tool. It is a graphical tool which helps to study the prices of stocks. And this tool actually helped me. Whatever profession you pick, you need actually a tool that can move you ahead. Up till now, I was working without a tool, and now when I got a tool, I felt more competent that I can actually go to the markets and trade on myself. Success came to me when a system was followed. I also got this thing that whenever I was trading haphazardly without any system in place, random buying, random selling, it never pays off. Whenever you have a fixed system in place, which you have maybe sort of back tested as such, then you will be able to get profit. I got placement into an insurance company. The name was Max New York Life Insurance in 2008. And post joining the company, I worked there as a research analyst, which was not a very enjoyable job for me. I was just trying to maybe shift away. I wanted to be in the world of stock market, but was not able to take the risk of leaving a job and going for trading full time. Then a change happened. The crash of 2008 took place in the markets, and my father lost a lot of money in the markets. So that made me feel that the trading strategy or the trading success that one is trying to follow by becoming a trader which is having even limited tools, it is not going to fructify. And to make this work for the long term, something needs to be changed. So I got a call from a friend who told me that there might be a long-term opportunity in Mumbai, but you will have to take some risk alongside it. So I trusted my trading skills, and I have already been exposed to the fundamental world, fundamental part of the stocks world. So I left my job at Gurgaon, and then I shifted to Mumbai, where I thought I began into the next stage of the trading. So you can see that is what happens in life. First you try, then you fail, then you again try, then you might fail. Then eventually success should come ahead of you. Talking about the last 12 years, for my journey to be trying to become expert trader, I'll not call it I have become an expert trader. There's a long way to go. I'll talk about the entrepreneurship part for me. I joined the current firm which I've been working for 12 years. I took a risk and I started working at nil salary. There was a zero salary. And I instead wanted to become a partner in profits and loss instead. So in this, what happens that whatever money, if you lose some money, then you have to pay to the broker. If you gain some money, the broker pays you. So I had confidence in my trading. So I went into that model instead of a fixed salary model. So another change happened into me, that basically up till now I was trying to trade stocks, which you just can trade unilaterally, like you can buy or sell to make a profit out of it. But here, using options, there were a lot more opportunities that came up your way. And I understood system trading in greater depth. The past experiences had helped me, and we did well in the fall of 2008-9. There was severe recession going on between 2008 to 2009, and since the knowledge of options, everything helped me to gain much. And next, what happened was we opened a new company called FinIdeas. It was basically a fintech company. It is into options trading, stock market softwares, and wealth management. Even after forming the company, I was not satisfied with it. I felt that it is taking a lot of my time away from trading, and it's not adding much value to my system. If your first love is trading, you'll not want to enjoy others. You may not enjoy doing other things. So that is the path. I exited the company after 2 years. This was when startup culture was not there. This was pretty much earlier than that. And I sold it to the other co-founders. The company is still in existence, and it is run by my other co-founders. And talking about what I am doing since last 12 years or so, I'm an options volatility trader. The term volatility might sound a bit different to the people who are not belonging to markets as such, but volatility means very huge fluctuation. The fluctuation in prices, basically the fluctuation in the prices and the underlying stock, that is basically volatility. The speed of fluctuation, basically. I manage a portion of the broker's fund. I use algo trading, like Vivek said. Using algo trading only, you can move forward as of now if you're looking to scale up your operations. I trade the volatility of the market. I don't trade prices as such. I trade only the volatility of the market. We are having multiple strategies that work in various type of markets. We strive to achieve good returns, and we trade all kind of index options. These are some of the screenshots of the softwares that I use and at my workplace. And what are the learnings for the wannabe traders? They are basically, in the beginning, I had talked about the audience, that there would be many wannabe traders, and there will be investors for whom we should have. I may give some advice. Talking about the wannabe traders, you should focus on why you are here and what do you want for the markets. Having a good trading plan in mind, you should know your exits, your risk reward, everything in each trade. Basically, what happens is that we've heard a lot of things, that there are so many people who are interested in stock markets and they trade on their own, say for example part-time in their jobs, and kind of they might lose some money out of it. Instead of, when you're trying to make some money of it, you end up losing money. So these are the basically 6-7 valuable advice which can help them to save their money. And I'll advise them to basically have a focused strategy in mind and gather tools through which they can earn profits rather than going things randomly. And the most important rule is trying to safeguard your capital. Never let your capital go away. And talking about the final slide, talking about the investors per se, basically I have an advice for you. Like Devam said, these are the returns chart for each category. Well, this is the market P ratio. You can Google the term. So what actually happens, we have seen that whenever the market is at higher valuations, there are a lot of questions. Should we buy? Should we sell? Right now, the market is at relatively medium level valuations. So should we buy? Should we sell? And generally what happens is people sell at low and people buy at high. I'll advise the opposite. Basically, you should track the P on a fundamental level, whatever SIP you're doing or whatever a bulk of portfolio that you're holding. You might try to reduce the allocation once the P starts to rise. This is basically ballpark theme that I like to share this envelope. And whenever the P goes less, as you can see that the 3 years, these are the CAGR returns basically from the markets. So as you can see, that lower the P, the higher the returns that you get from the market over a longer period of time. In fact, say for example, above 24, 27 Ps on a shorter term duration, you don't get such high returns. Thank you so much. And I'll transfer the chat so that the moderator can take up for Q&A. Thank you so much.
So just checking if you guys can hear me again. If you can get me a confirmation, yes, you can. Much confirmation. Yeah, I can see Shivam confirming. Thank you. So thank you so much, both of you, for this lovely introduction of yours. And obviously, your story is quite inspiring because both of you are doing something unique in your career. It's not easy to be a trader, trust me. Especially, it's very difficult to get married in India if you are called an options trader. So I'm sure you had your fair bit of luck there. But yeah, this is not one of the occupation which was recognized at least a decade ago. But now I think it's one of the occupation which is just taking global work, global markets. It's like equivalent to being a doctor or a lawyer. Trader is pretty much a well set occupation. And being a fund manager, we all know how tough it is right now. So great, guys. So I'm going to moderate this Q&A for coming 30 minutes. And I can already see a lot of queries coming in. I'll pick the queries and I will address the query to either of you. And wherever I see the queries for me, I'll take it over and answer those queries. All right. So I can see the first question, which is more, I think it's for me. And I will take this question from Praveen. That the question is for StockEdge, how did you scale up and marketed the product? Do retail customers pay for the information which is available in Money Control or Screener website? Okay, so if you see uh, last 3 to 4 years, a lot of things have changed globally with respect to customer behavior. And this change obviously started in 2008 when things actually moved out from a seller's den to a buyer's den. So the relevance of premium content has gone up significantly. And even in media, if you see, there are platforms like the Ken, who's literally asking for a subscription for a premium content. So yes, there is a behavioral shift which we are observing, and people are open to the idea of paying for a good value-added services. But then in India, the tendency of paying for a product is still less. So all we would need to do is build a service around the product so that people perceive a better value for the service. And the case in point is Amazon Prime. So the moment Amazon introduced Prime, there were not many people subscribed to Prime, which became one of the important subscription revenue earner for them. So similarly for StockEdge or any product, for Money Control also, you see they have introduced the premium product, and Screener has also introduced the premium product. So eventually the freemium model, which is actually the base of our business working now, and which I think is the base of a lot of businesses working in future. So any product which you develop, especially the tech oriented, it has to be freemium oriented in India at least. Okay, I'll take the other question for the other speaker. Okay, the question from Nitin Bhargava is, and this is for you, Devam. How do you think this downfall will be more than 2008? Or do you think it will be more than 2008?
So yeah, so that is a question on everybody's top of the mind right now. It is so my personal feeling over here is that see, obviously incremental developments will influence how much the downfall will be, because globally you are seeing a situation wherein there is this virus which is obviously on a rampage. And apart from that, there are several ramifications of it. I mean, the world shuts down. But the financial obligations don't shut down. And the longer the shutdown continues, the more time it takes. Probably, let's say, a vaccine comes in probably 9 to 12 months from now. So during that period, how much pain happens? How the various numerous players in the global economy, how they play their roles up, because if there is some geopolitical dislocation, I mean, what we saw between Saudi and Russia in terms of the oil side. So world is going through a demand shock. If another supply shock comes in on top of this, then there could be a much higher fall globally. From India's perspective, so two things I'll just highlight which are good for India's perspective, and that's where I feel probably rather than how much we can fall, what I would look at is that whenever something comes to attractive levels, one at least should begin a tapered buying over there. Ideally, let's say mostly what will happen to most of us is that we are fully invested whenever, let's say, the market goes to comes to attractive levels. So probably if you can create some cash at that point of time, if your asset allocation permits you to move something out of let's say your fixed income options or something else, then start buying whenever the things start becoming attractive at certain level, and don't see near term, because near term at that point of time will be heavily dark. But ultimately over the medium to long term things figure themselves out. I mean, the cure for low prices will eventually be low prices. So in that with that scheme of mind, one will have to take it ahead from here. Otherwise, if you ask me, in the very short term, there is very good reason for people to be bearish on the markets, just because there has been a technical rally and all those kind of things. However, from the medium to long term, I would rather suggest an individual investor to stick to investing on downfalls in the current market. I mean, because this is a great market to make money from the longer term perspective.
Okay, so Devan, one question, just a follow on from my side, as a follow on to your answer is, do you think mutual fund sahi hai?
So I feel see, mutual funds is great in its own way. Mutual fund is one of the platforms you can choose to do equities. So it is a it's a pretty regulated and available to the mass market sort of a platform. So whether one chooses a mutual fund or a PMS or an AIF or direct equities, it's more of, you can typically go through one of these four routes, or then you can take a structured option if you want to invest in equities. But each of these options carries their own risk returns. So as long as you are doing a SIP in mutual funds, and I think what probably, I don't know if everybody could see the slide that I presented or the last slide that Vikas presented. The simple thing you can do is that whenever the ball is in your side of the, I mean on your side of the pitch, that is whenever the valuations are below 15 PE in India, given the huge growth potential that the country carries in the global context, just double or triple your SIPs at that point of time. So if you do that, then whether mutual funds or whichever route you take, equities will definitely give a superior return to various asset classes in that situation.
Okay, Vikas, your take on these two questions you have?
No, I'll tend to agree with Devam, and I don't look at fundamentals, so
Okay.
I'll not have an idea about it. Yeah.
Okay, so I have a question for you, Vikas, again by Nitin Bhargava. Which tools do you use?
Okay, basically, there are different providers providing different set of tools. So what would be required by me as a full-time trader might not be suitable to a relatively someone who's at the intermediate level. So basically, I'll be using, say, for example, Gets. There is a company called Greek Sort, so I'm using a Gets terminal. There might be some other softwares which I'll have to check on the option Greeks. So there might be other softwares like Wallet and all. So those are advanced level softwares. I believe you're talking about the intermediate level where you want to access the charts and all those kind of things. So there are numerous. There's a very wonderful tool from cdiff.com. If you can check my FNO, basically they are having a lot of details out there. You can have a range of data points, say open interest, put call, everything is there. So I think those kind of things are there. Plus, you can use ME Broker, Metastock, and say from Falcon for looking at the charts as such. And for advanced level things, I think well, I'll have to get into specifics, basically knowing that what you are trying to trade, basically.
Vikas, I thought you remember I am also here.
No, you already marketed yourself, so I didn't want to overburden the crowd.
Just kidding. Just kidding. Just kidding. Okay.
No.
Okay, Pratik is asking a question. Can you talk about your trading strategies? Which one do you use?
And sorry to add, but StockEdge is a fantastic tool. I've been using it, and I'm a user of web StockEdge, basically. So basically, I'm not a fundamental person as such, so I look into the technical aspects of it, and it's a wonderful tool.
No, just I'm kidding. That's okay. Can you share some trading
I'm saying the
strategies?
truth.
Can you share some trading strategies for Pratik? Any? I mean, at this scenario, any trading strategy one can deploy in market using options?
Basically, if, I don't know what stage of trading he is in, so I would not try to say something which can act as a double-edged sword for him. So basically, looking at his own expertise level, basically you can try to buy options or sell options or have a limited risk in your portfolio. Don't try to go with an unlimited risk. Have a hedged position. Whatever your view might be, it might turn out to be right, it might turn out to be wrong. But have a mindset of protecting your capital and try to look out for a good risk-reward ratio before initiating a trade. So those kind of things, have your exit plan in mind. So
Okay. So one question is from Mayur Udarani. Are historical P, I think Deva would be able to answer this. Are historical P a good tool anymore, given there seems to be a structural change in consumption patterns?
So, yeah, it's a great question, and I mean, so PE ratios in general. So people argue that which is the best valuation ratio. Some people claim that price to book is obviously probably the most standard valuation ratio, which will be good across cycles. So PE, one just should take it with a pinch of salt in the perspective that sometimes earnings are too depressed. So in India right now, what I was trying to say earlier also was that you are coming off a cycle wherein the Nifty earnings has grown at 6% CAGR for 13 years, while your real GDP CAGR might be a little bit similar or higher than that. So I mean, nominal GDP is obviously much higher than that. So yeah, so that's where you should just be a little careful. I mean, at what point of the earnings cycle you are when you look at PE, because if earnings is depressed, then the market will bottom out at a slightly higher PE. Because see, the market is a collective wisdom, and collectively the whole crowd does not get it wrong over a medium to long term period of time. So keeping that in mind, if the earnings is suppressed, just keep that in mind while looking at PE. That's where probably 50 of 2000 similar PE of 2020.
So I'll just add my 2 cents into this. Actually, I recorded a video which is hosted in YouTube channel of Elon Markets regarding this, and that whether market is fairly valued right now or not. And I did this calculation of PE multiples. So just to give a quick number check. So currently, Nifty earning is around 480 rupees. That's the historical earning per share. And if you see the market right now is around 9,000. So the PE ratio comes to around 18.75. I'm talking about the trailing P ratio. Now, historically, market has been in the range of 16 to 18 P ratio. That has been the long-term average. Having said that, in 2018, when market went down because of massive fall everywhere, the P actually went down to as low as 10. So when there is a liquidity driven selling happening in the market, PE actually has no meaning. Having said that, if the market becomes stable and there is enough liquidity in the system and a lot of money gets pumped into the system, then obviously market will tend to become more expensive and it can go up from here. So depends upon how this whole episode plans up. If there are more liquidity driven issue and things go down everywhere across all asset class, then obviously PE will lose its relevance. Okay, I have one question from Amol, which talks about what are the preferred momentum oscillators. Vikas, you would like to put light on this?
No, I don't track basically the momentum oscillators as such. So I look at pure price and volume basically. So I don't look at the oscillators as such. So I'll not be able to comment much on it. Yeah, I earlier basically tried. I think so. You're talking about MACD, RSI, those kind of things. So basically, that has a limited. I didn't have much success with it, so I left it out around say 10 years back. Yeah.
Okay. So I have one question now, which is more from a business perspective. That Saravanan is asking a question: what is the business model of your equity advisory firm? And I believe it's for Devam. Do you charge per research report or subscription model? Also, how do you scale up such a businesses?
So that question is for me, right?
Yeah, I guess because you are into advisory.
Yes, absolutely. So yeah, so basically it's a very hands-on client-wise approach that we take. So typically we don't charge for research reports. We do make research for client-specific requests or client requirements. But we don't we don't have like a subscription model wherein we send out research reports on subscription basis. And yeah, so the focus is to create a portfolio for the client based on his risk and return profile, and try to see whether it is on the right asset allocation. And over there, typically one rule we follow is that in any asset, whenever there is a dislocation, it is pretty rewarding to look at taking a more concentrated bet over there. So from that perspective, if there is a dislocation in equities, then we would suggest a client to look at it from a direct route perspective as well. Otherwise, when the asset is heavily crowded, we would generally prefer a diversified route to play it. The diversified routes would be things like mutual funds, or index funds. And when there is, obviously the asset allocation over there would be lower. But when there is a dislocation like this, then there's a good chance to play through a more concentrated route. Whether it would be direct equity advisory or it could also be a PMS or an AIF, depending on the requirements and needs of the client.
So probably he also wanted to know your revenue model. So is it linked to AMC fees on the capital you manage for the client, or is it purely linked to the alpha you generate for the client?
So revenue model is purely advisory based fixed fee, which we would get. Plus, there would be certain cases wherein we could look at a revenue share. So it's a hybrid sort of thing. Most of the cases it's an advisory related fixed fee. And there would be that odd case wherein we could look at a revenue share. Upside related share.
Okay. Okay, Sanjay, this question, I think Vikas, you're the best person to answer this, is where to start if I want to learn options trading?
Basically, there are many, first of all, there are many websites as such which provide basics of options. You want to go deeper into options, say, for example, option Greeks and advanced level of options training that you require. There are many service providers in India. Say, for example, FinIdeas would be one. They are having classroom coaching as well as online coaching module. And I believe StockEdge also, the the Elon Markets platform also gives a lot of details about options. Basically, what are the different kind of strategies that you might undertake, and what are the results that you might foresee for them. You can learn basically also on the CDIF platform, where you can actually try and test your strategy also, that what happens if you buy an option, sell, say, another option, or if you want to make various, there are different level of combinations that can be made using options. So all those things can be tried and tested there as well. And I don't remember names as of now. Whatever came top of mind, I have spoken about them. And
Okay.
That's it. Yeah.
Okay. So we have this website called elonoptions.com. It is fantastic website with a lot of free content, and you can actually play games there. You can practice whatever you want. So if you guys want to learn the basics of options, I think that's the perfect tool which is available for you guys. The name is elonoptions.com. Okay, we have a question from Mr. Deepak Kapoor. I don't know, he is the same Deepak Kapoor, but still, let me ask this question.
Yeah. It is.
So why is he asking question of trading? Why?
He is taking a test.
Why is he making fun of
for
us? Okay, just kidding. So he's asking a question to you, Vikas. God save you. You said after getting some trading tool, it becomes easier. What good trading tool would you recommend? Also, your one or two favorite books on trading.
I think I've read very few books on trading. I think I read the one partially. This is the 1930 crash. I don't remember the person who lost money around 5-6 times, then again picked up, made entire capital. He earned back his entire capital, made millions of dollars. I'm not able to remember his name, and he's a very famous personality. I'm talking about the 1930 depression of America, and it's now on the top of my mind. And basically, there are certain. I think Greeksoft is a very good vendor. Basically, it provides automated tools, option analysis tools, and there are certain chart providers, online chart providers like iCharts.com, Chartlink.com. Investing.com is a very good source, basically, of late. It is giving the data across the world. And Falcon and FinIdeas, I think these are the names that comes to my mind.
Okay.
And I think I missed something. There was some more part of the question.
Yeah, no. So he was more eager to know about the trading tools and the books. Maybe you can take it offline and talk to him later.
Yeah, I'll take it offline. He'll quiz me. Yeah.
Okay. So Ujjwal is asking a question. Do we see commodity stocks, for example, oil, steel, etc., stand on uncertain stage? Do we see commodity stocks like oil, steel, etc., stand on uncertain stage? I guess what he's trying to ask is, what do you think will happen to these stocks?
So I'll basically try to answer that one. On commodity front, see right now, for example, if I begin with oil. Oil has seen a disruption and the prices are down to levels wherein most guys will. I mean, if you which geography you are looking at, that obviously makes a huge difference. As long as you are dealing with somebody who is a very low cost producer and you're investing in them at current point of the cycle when the commodity prices are down, typically the multiple might look high because the earnings won't be there. But whenever it reverses very sharply because ultimately the cycle plays out. So, and it also depends a lot on, I mean, whether the commodity gets phased out or not. So, as long as something like oil, there are multiple industrial uses apart from just auto related. And in case if because of that reason, whenever it makes a comeback, then if the company or the name or the stock that you're looking at is not so leveraged, there's a very good chance that that stock will come back strongly at that point of time. So basically, the simple golden rule in commerce is as long as your balance sheet is not highly leveraged and you are investing at a point of time wherein you are investing in a low cost producer, then there is good money to be made when prices are down to such levels. Also, replacement value is a very good thing to keep in mind when looking at this kind of names. Having said that, one has to remember that commodities is something which in the current scheme of things, I mean, currently, let's say there are various sectors which will be favored. So commodities is something which will come a little later for any investor. I mean, it will be 6 to 9 months post or 2 to 6 post things stabilizing that the fundamentals will really start improving over there. So one is to keep that in mind while investing in commodities, but it can be rewarding from a medium-term perspective.
Okay.
And Vivek, yeah, just to add to the previous answer, not this one, the one before that. This I remember the name. It's Jesse Livermore, basically.
Yeah.
Jesse Livermore was a great trader and ultimately committed suicide. So nothing to do. Okay, anyways. Yeah.
We'll take that suicide part in the next webinar. Okay.
Yeah, because the lockdown.
Hopefully we don't need to. Hopefully we don't need to go there.
Yeah. Okay, Mr. Hari Prasad is asking the question to Vikash. The volatility swings so much in the recent dates and it has reached almost 2008 high levels. How do you manage the spikes? If you book the option, how did you manage your theta? Wow, brilliant question.
Yeah. First of all, I believe this is not from IIM Indore. If you remember the name, Mr. Hari Prasad, our finance professor.
I am sure he is the one. Finally, I'm so happy that he's asking these kind of questions.
Yeah. And he had a portfolio too.
Yeah, go ahead.
Yeah. Talking about this question, basically, what we basically do is we don't buy a certain option or say we don't have a one-sided position. Say for example, if you're buying a option, we simultaneously sell another option. So that is the way we manage our theta. It's not like we are buying, say, for 10,000 quantity of an options and keeping it that way. We are not trying to speculate in the market. What we are trying to generate is a fixed return kind of a thing. So if you say, for example, we find some option that is cheap in volatility, so we tend to buy that. There might be certain option which is expensive in volatility, so we try to sell that. So we try to make a spread and a arbitrage benefit occurs. So we try to capture that portion. So when we are simultaneously buying a option, selling another option, so we try to take the care of the theta part. And you might have a further question to it that say for what happens if the market lands on the other side and you end up being short or long side. Then what we do, we have options buy sell position for the entire strikes. The entire market will be having different strikes at which we'll be being long and short. So the net position for the net effect on portfolio will be very minimal. So that's the thing. So we don't end up paying theta to the market, nor we try to earn theta from the market. What we try to do is a market neutral strategy.
Okay.
And using algorithms that helps us a lot, and it actually happens very fast in real time. So what we are not doing, what we are doing is placing multiple orders through a automated software, and that keeps on looking for the kind of opportunities that we are trying to take from the market. And whenever those opportunities are taken, a position is created. So that's the thing. Over to you, Vivek.
Okay. So, okay, Devan, you are again on line of fire by Mr. Kapoor. The question to you is, if one is investing fresh today, what will you suggest as an ideal mix of fixed income, gold, and equity for a long-term investor?
Yeah, so I would generally feel that one should look at, I mean, obviously it will depend on the kind of risk appetite of the investor. So I'll just mention for the balance profile. So in the current environment, one should be ready to go up to, let's say, 40 to 60% on the equity front. And the remaining to be a split between gold and debt. So gold, basically, as long as the investor has a global possibilities, it will make much more sense because gold is something which is which has potentials to invest in. So generally, we believe it could be like anything like 50, 20, 30, 50 in equities, 20 in gold, and 30 in debt. But because and gold is an unusually high allocation right now in the current environment compared to most other times, because globally there are so many uncertain and moving parts that various endgames will lead to a situation wherein gold will do well. So because of that reason, one should have gold in the consolidated portfolio. One important thing over here is that equity obviously won't come up immediately. It will be formed over a period of time because, like we all mentioned and like you also highlighted, that at a P of 18 or 20, given the current uncertainty, you will probably see various opportunities to build the equity exposure. So yeah, so I think, but you can broadly look at 15, 20, 50, 20, 30, 50 as equity, 20 as gold, and 30 as fixed income.
All right. Thank you. This one is from Shaunak. This is for me.
Yeah.
Yeah. So this is for me.
Go ahead.
When are you coming up with the desktop version of StockEdge? Buddy, we just launched it. It's called web.stockedge.com. So do have a look and enjoy the feel of a good product which has been built. Okay. You say?
So I had a couple of
Yeah.
I had a couple of questions from more personal, not market related. So one of the questions is from Vaibhav Jain, especially to Devam, but I'm sure Vivek, you also have some story to share on this. Can you tell us a couple of interesting client engagement stories which have left you a good or bad learning experience while you were handling them, especially in these, if you have to call someone and tell him your portfolio is down 10%?
Yeah, I can first take that question probably. So in this current situation, it is a situation wherein equities have seen a fall of like 30 odd % in a month. So obviously most portfolios and most clients would be fairly worried about that. And that is something that does lead to a situation wherein clients do end up being disillusioned sometimes. I would obviously I'm extremely blessed in a way that I've got fairly patient clients on that side. But one thing I believe which will help is that one will be extremely frank and candid with the client regarding if at all, let's say there would be most cases what people end up doing is that when portfolios fall, they compare with the markets and they say that well, the portfolio has fallen this much and the market has fallen more, or the portfolio has fallen a little bit more than the market, but it is because of these 2-3 reasons. So yeah, first thing I think which my personal approach is that first point out if at all there has been a mistake or a thing which was unanticipated which has happened. And then at the same point of time, do provide all the explanations. Obviously, clients have a right to be angry if or be dissatisfied if the returns are suboptimal. But in the last 2 years, the markets are, I mean, from 2018 to 20, the markets have been fairly challenging on the broader market front from that side. But as long as you are frank and candid with your investors, and most important over there will be the asset allocation. If the asset allocation is fine, then I would believe that clients will be fair with you.
Right.
Okay. Anything to add, Vivek, on that?
Yes.
Maybe if you have any client experiences.
Yeah, I mean, we have client interaction quite a lot, but good point is that, I know my limitation and I know what is something which I can't do. So I've never been in the process of managing clients' money. I think I can get massive, serious, sleepless nights if my client is losing money. So I've never had a single rupee of any other person managing or advising. I've always managed my own capital and build up my own capital. But having said that, my client-facing businesses are more knowledge, data, analytics driven. And there we have, I mean, literally every day we get around 300, 400 people who subscribe to our services, and they have all kind of weird issues. But those are operational in nature, and wherever I think I need correction to be done on the content side, we revert back with our corrections. But fortunately, not into fund management, so I have a pretty good sleeps.
Great. So another question from Deepak sir for Vivek. See, when are you doing the IPO so that we all can ride one more wave with you?
Deepak sir, the moment I
In the
make
friends and
money,
family.
the moment I make money. And these, for me to make money, first of all, SoftBank has to die. Someone has to kill that bastard. But till he keeps on funding idiots, and you know, Deepak sir, what I'm trying to say, then one has no option then to also be in the market to raise more money, and no one will be able to see what kind of what is profit. The whole concept of corporate finance is getting rewritten. So, but still, fortunately, I am blessed that I am with and Vineet Patawari, who is my partner. We have been always running a business as my own business and focus on more profitability. But still, we are running on a cash break-even, sir. We are not making money. The more you tweet about us, I think we'll be able to make money. So, make your Twitter handle active, sir.
Great. Vikas, one question for you on the personal front. Have you
Okay.
ever felt that you took a wrong call to become a full-time trader from your corporate job? Or do you still think that it was the right call for you?
Basically, how things panned out was good. So I believe I never faced actually that issue. Once I turned into full-time trading, fortunately, this kind of trading is something which is giving consistent return in the what to say in every type of market. What actually happens when you're trading randomly or you're trying to guess a direction or sort of speculating, you get sleepless nights. Basically, you are every day looking at the Dow chart, so how it is closing, how it's opening, and you're losing out on your family time. So my valuable advice will be try to earn less money, but be at peace with yourself. So those kind of things help. Basically, you don't go for over leveraged positions. Basically, so I didn't feel something in the last say 12 years or so. I never felt this issue. I never felt like quitting. And this is something like this is my dream come true. I have a more balanced time with my family. I can leave my office by say 4 o'clock or something like that. So I'm not bounded by other things which other corporate employees might have to face. So I tend to enjoy this thing. So I'm getting my time as well and the mental peace and probably the money. Yeah.
Superb. So we have a couple of more questions. One is from Lokesh Sancheti. The mutual fund and hedge fund markets in India are still developing with great growth potential because of the low equity penetration. Do you think this is a business opportunity for a finance entrepreneur to start a small fund house focused in semi-urban areas? So it's a more entrepreneurial probably direction that a attendee is asking. So any of your views, please.
So I'll take this. Let me share some numbers with you. So in India, if you see the demography of our country, there are around 8 crore mutual fund folios and only 2 crore unique mutual fund investors. And if you see the equity market participants, there are around 4 crore equity KYC with the exchanges and only 9 lakh people who are active in equity market. So by and large, if you ask me, there are not more than 2.5 crore people who are actively managing their financial investments, right? And we all know that fact because the credit card penetration is low. But you know, this thing will change because eventually the way things are progressing with more wallets coming into picture, there are almost, Paytm itself has 30 crore wallets. And these things will definitely change and there will be massive penetration. Last year, 65% of mutual fund growth actually came from tier 2 cities and beyond. So if you ask me, I'm totally in game with you, and that's what we are also focusing now, is going vernacular, focusing on tier 2 cities and beyond, and building up strong business base from here. But the only problem right now is that the industry is going through a massive transition. And I would say that even the regulator is kind of confused because they don't want intermediaries to make a lot of money. At the same time, they have not been able to protect the interest of investors. So this transition, you will have to see a lot of pain in coming 1 or 2 years. But then whoever wins the battle will definitely get the larger share of the pie.
Great. Devam, you want to add anything? Or Vikas?
Sorry.
Do you want to add anything on this?
No, I guess so. Only one thing which I probably found a little bit unusual in the question is that the question was on launching it in semi-urban area. So that part, I mean, so see, most of the houses which are there, I mean, they are all pretty large names on the fund management side. I mean, if he's looking at the distribution or the broking part, then definitely what Vivek said is very relevant also, that it will, because the regulator wants to crack down on intermediation over there. On the fund management side, most of the larger funds are actually tapping. They have serious plans of. I mean, and they are tapping into the B16, whether you say bottom 16 or bottom 32. They are tapping into all those cities in a very strong way. So it is not going to be very easy for anybody to come up with a fund house unless you have deep pockets.
Okay, I just want to add here. Actually, I thought from a perspective of a distributor, but if he's thinking of having his own fund, then obviously fund management business is also will be going through a massive disruption in India, and that is happening globally, where the fee-based income will start getting questioned. And lot of now new generation fund houses will come who will only charge based on success. For example, Zerodha has already applied for mutual fund license, and they have clear intent of only charging the customer out of the success if there is any success. And ETF, you know that for ETF to be successful, you need to be on a larger, bigger scale game. You can't have 1,000 crore AUM and make a lot of money. So make sure the business model which you make, financial model which you make, don't assume 1.5–2% of AMC earning. It will not happen. This has to come down because the new tech guys, I mean, I got an opportunity to meet Sachin Bansal a couple of months ago, and I was trying to evaluate what he's doing, how he's thinking of, and the whole new thought process of these entrepreneurs is very disruptive. So the fund management industry is not going to be as lucrative as it is right now because the overall revenue from fund management will go down, or it will be more variable, which will not give stability to the earning. But there is scale.
Superb.
A huge number available for everyone to capitalize on.
Nishikant is asking a question which I think is very valid for a lot of us salaried individuals on the panel, on the webinar. We have been allowed to withdraw part of our PF right now. Would you recommend using part of the PF savings which we withdraw now to invest in equity in the current market?
Devam, I think, is a person should reply first.
What I would suggest is that see, typically results like this, whether it's PF or results like this, should best. I mean, it's the last part you get into in terms of investing in the markets. If the asset allocation is fine, I mean, as long if you let's say you're moving up from if you're a balanced investor or if you're depends on what profile of the investor you are, but let's say if you're a balanced investor, if you want to move up from 50 to 60 in equities, that is perfectly okay. Also, in the current market, I would time it a little bit because there is a clear-cut technical bounce in there. But I would generally refrain from doing all-ins. I mean, in such situation, even today. If you get a market at like 12 P, then obviously one can look at those kind of situations. But you have to understand that even 12 P or let's say a cyclically adjusted 14 or 15 P is another 20–25% downside from current levels. So keeping that in mind, one should look at drawing into such reserves.
Almost, it's just about 7 o'clock. So last questions for each of you. Vivek, a few people have texted me on the WhatsApp to say, why don't we have a IIM Indore alumni or student discount on StockEdge premium or the paid service. So I'm putting out the request officially on behalf of all alumni and students. We want a discount code. We'll pass it on to everybody. Don't worry.
Kaam ho jayega.
Yes. And there is an IIM IDR ID. So we have an email ID with IIM IDR on it. So all of us don't have it because we are older alumni, but the younger ones all have it. So you will be able to verify that it's an alumni only.
Till you promise me to give me feedbacks and make our life slightly tougher, I'm fine with it.
100%. Vikas, there's a question from Manoj Verma for you. which is, could you share your learning from your biggest loss in trade? So I'm guessing this is a single transaction loss or whatever transaction set that you have done that is referring to.
Probably the first thing comes to my mind is I should never have taken that trade. Yeah. Other than that, I think so. Those 6 points that I covered basically whether it was a calculated bet that you had taken or it was something that you didn't follow the discipline basically that was required of you. So that can actually hurt. That if you're not disciplined and then a loss is being taken, that actually hurts. That could have been avoided. So those things are there. Maybe. And other point is like you have to try and protect your capital. You have to try and manage your losses. And I think so. I think these were the biggest learnings basically. This is not the basically learning, but how to try and tackle it so that it doesn't happen to anyone. So in basically talking about say when I was a novice trader around 16 years back, that time I had taken borrowed money from a friend and put it into trade. It didn't work out. I didn't feel good about it. It never feels well. To be a trader, you have to witness the highs and lows. The EQ required is tremendous. Basically, you have to see a portfolio changing every day. For the equity investor, it's a different story. But for a live stock market trader, you keep on checking your P&Ls every now and then. So if the markets does something dicey, you are at the merit of the market. So those look, you have to try and unforced error, basically what you're trying to call in tennis, that should be avoided. And whatever, if you're playing a strategy and the losses come, that is fine. That is a parcel of it, and the risk and reward goes hand in hand. But what you should be looking out for is undisciplined losses. So that should be taken care of.
There's one more follow-up question, Vikas. Sorry to add on. This is from Praveen. It basically he asks first is for the algo trading, and you already mentioned that in one of your other answers, so I'll not ask that part. But the other part is what I'm leaning to. In US, they have dark pools, front-running order. Do we have these malpractices in India? If yes, how do individual traders like you handle it? And he also goes on to add, I am working on a system using interactive brokers API or Zerodha API. Are they really live or is there any latency?
Basically, I'll take these two questions part by part. First of all, I'll talking about the Zerodha API and this thing. But I have not been working on the technical side of the coding that he's talking about. I know about Zerodha API that you can use it to manage using various clients, and you can code your own strategies into it. Similar with interactive brokers as such. I'll not be able to comment on the latency part. Whatever I would know that our broker is having a co-location facility with the exchange, so that the brokers using those facility to trade with the National Stock Exchange will have a faster access versus some other broker. And say for example, you're talking about, I think he's taking the internet route into it. Basically, the Zerodha interactive brokers is all the internet route. Basically, there is another system called the lease line method of communication, which will be probably faster for the brokers who are directly connect. Some amount of latency, the delay would happen with the systems guys who are using the net facility to exchange the exchange, but that would be minuscule, I believe, in some milliseconds as such. And what was the other question? I forgot part of it. What was the other question?
In the US, they have dark pools, front-running order. I don't even know what this is.
Okay. Basically, it is front-running might be in certain stocks as such. Basically, I'm not trading into any stock. Those will be mostly for the mutual fund people, and who will be going to. I think Devam will be a better position to take that question. Devam or Vivek, basically. And for index, no front-running kind of thing happens basically.
So let me add my 2 cents here, because I run one of the largest algo trading desks in India now. So first of all, we have to understand dark pool is not a malpractice. Dark pool is a concept in US which allows brokers to create their own order management system and match orders of their buyer client and the seller client. And finally, the net position can go to any exchange. In US, there are technically all brokers have dark pool. So there is nothing wrong having a dark pool. As far as front running order is concerned, front running is when you have sensitive information and you want to trade earlier than the market. And obviously front running happens everywhere. I mean, people who are mutual fund managers, some people do definitely front running. Brokers who release brokerage report will do front running. Maybe the analysts were involved. So it is not something new which is there, which has been a practice. And obviously the rule of the land is now becoming stricter and stricter, and it is trying to penalize people who are doing front running by identifying their communications or by keeping restrictions like you can't carry mobile phone and you can't do XYZ. So front running is the global phenomenon which happens everywhere. You can watch all those Wall Street movies and you will understand what actually works in global markets. Second part is your API with Zerodha or Interactive Broker. Now, as Vikash has already communicated that, people like us have a direct connection with the exchange in co-location, and our connectivity with the exchange happens on a nanosecond basis. But if you are using Zerodha API or Upstock API or Interactive Broking API, somewhere you are connecting yourself to their server first, which is typically through internet. They will not give you lease line because it's very expensive. And obviously, if you're a high value client, they can also install a lease line for you and give you co-location server also. But if you're a normal retail investor who using their API, then you connect to their server, which in turn goes to the exchange server, and there is a latency. So obviously, you have a disadvantage there. So if you are looking to do high frequency trading, you can't do using their API. Then you have to become part of a prop trading desk, a member of the exchange who has their own colo facilities. For example, Vikash has the broking firm. He's part of that broking firm. So using them, for example, we have iRage, which is an algo trading firm. There we have our own membership. So you need to become part of them. If you are using broker, then you can't do HFT. You have to restrict yourself to low frequency strategies, which is typically a keep position for longer duration of time. It could be for a few hours or it could be for a few days.
Cool. Last question for Devam. Devam, I know we are not your clients, but we're IIM family, so we're going to ask you for your top 2 or 3 picks, which we can pick up in this market tomorrow or Monday morning, and what you're advising your clients right now.
So I am basically in the current markets. Obviously, there are opportunities galore from a short to medium, from a medium to long term perspective. In the very near term, there will be heavy volatility. But I would generally suggest that, I mean, one question got asked on commodities. So if one is willing to look at across cycle, and so it also depends on what kind of, if you're willing to look at across cycle, then some of these commodities, I mean, you can choose a strong balance sheet commodity, and that should do you extremely well across cycles from the current levels. Then there are various thoughts, various schools of thought going on in the market. And see, it's very risky to give out 1 or 2 names, because it's like saying that this guy will go out and make a century in the next 5 innings that he'll play, which is very tough. But I can definitely give out a portfolio, which I feel will do extremely well over the coming 12 to 18 months. Having said that, any good mutual fund, if you pick up, that will also do extremely well over the next 12 to 18 months. And there are spaces which are just beaten down to disproportionately compared to where their general businesses are. So those are wonderful opportunities.
Can I add my
Great.
here?
Sure, Vivek. All 3 of you, yeah.
So see, my investment theory is largely around circle of competence, and I would seriously advise all of you to look around yourself and see which product are you using right now sitting at home. The most relevant product right now, which all of us are consuming, is data. And the only company which has built a fantastic pipeline to all of us in our life is Reliance right now. And obviously, Bharti has been there for long. I would suggest that without any hesitation, you can seriously look at both these companies and also look around your house and see what kind of products you are buying. And this is very Peter Lynch way of looking at market. What kind of products you are buying, and you know that Hindustan Lever cannot go down because everyone is buying Hindustan Lever. Even your family is consuming only Hindustan Lever products. So look around your family, look around your lifestyle, and you will find enough products, and bank on the companies who are manufacturing their product till you are consuming that product. The moment you stop consuming the product, get out of that company. Simple. And if you want more understanding on investing, just read 2 books of Peter Lynch. You are pretty much sorted. And obviously, Devan, I'm not taking credit from you. Obviously, you're a fund manager, of course. But at times it is important to actually keep track of what fund manager is also doing.
No, it's very extremely clear what you just mentioned. Yeah.
Perfect, guys. So thanks a lot, everybody. Thanks a lot to all the attendees and especially our panel, Vivek, Devam, and Vikas. Thank you, Deepak sir, in special because you've been behind the stage trying to help us curate this session and sort of be here. We wanted you to be on the panel, but your video was not working due to a bad Wi-Fi connection. But I assure everybody on the attendee side that we'll have Deepak sir on one of our panels very soon once his Wi-Fi is up and running. Thanks a lot to the Mumbai core committee team, Soham, Vaibhav, Sandeep, Mrinal, Shrishti, Vikrant, all these guys. Thanks a lot. And we look forward to having more of these sessions for all of you. If you have any feedback, ideas, please drop them on our Facebook page or anywhere else. And if you send us any questions, we'll try and link you all to our speakers for today also on their social media handles. So thanks a lot, guys. Have a great evening and look forward to doing this again.
Thank you.
Sure.
Bye-bye.
Thanks, guys.
Thank you.